Scott Bessant is celebrating what he calls a historic win in U.S.-China trade talks. He says he's pulled America back from the edge of a full-scale tariff war, one that could have doubled duties overnight. But behind the press releases and camera flashes, something doesn't add up. The deal being hailed as a diplomatic success may actually be a quiet signal of weakness. The White House insists a solid framework is now in place, a roadmap to rebalance the world's two largest economies. Yet when you look closer, that framework rests on shaky foundations. It's built on three fragile pillars: tariffs, soybeans, and rare earths. And together, they may determine who truly controls the next chapter of global trade. While markets cheer and Bessant takes his victory lap, uncomfortable questions are piling up. What did Washington really concede to get this deal? And can it genuinely protect an economy already stretched by inflation, debt, and rising prices? Bessant claims the U.S. reached a substantial framework with China, one that prevents a 100% tariff hike. He credited Trump's aggressive stance as leverage, saying, "The threat of those November tariffs gave us bargaining power. And now, we've secured new discussions on soybean and agricultural exports." On the surface, it sounds like a diplomatic win. The U.S. avoids an all-out trade war. Farmers get a lifeline. Trade flows appear balanced again. But beneath that optimism lies a more uncomfortable truth. Washington may have traded long-term leverage for a short-term sense of calm. This isn't a binding trade agreement. It's a fragile understanding built around three elements. First, tariffs. Trump's threat of 100% duties on Chinese imports forced both sides back to the table. Second, agriculture. China had cut its soybean purchases from the U.S. to nearly zero, devastating American farmers and forcing Washington to offer billions in emergency aid. And third, rare earths. Those critical minerals that power smartphones, batteries, and fighter jets. The U.S. wants China to delay its new export restrictions to prevent a supply chain shock. According to Bessant, Beijing agreed to two major concessions: restart U.S. soybean imports and postpone rare earth limits for a year. In exchange, Washington promised to freeze the 100% tariff plan. On paper, that's a win. The markets stabilize. The farmers breathe. The headlines look good. But no one outside the negotiating rooms knows exactly what Washington had to offer in return. The details remain secret. And that's what has investors and economists nervous. Because while officials talk about progress, America's economy continues to show cracks beneath the surface. Inflation hasn't cooled. Growth is slowing. Consumer confidence is falling. The optimism of a trade breakthrough can't mask the reality that everyday Americans are still struggling. Household sentiment has sunk to its lowest level in months. Long-term inflation expectations just climbed again, from 3.7% to 3.9%. In plain terms, people no longer believe prices will ever go back to normal. Rent, food, and fuel all continue to rise faster than wages. The cost of living crisis that erupted in 2022 hasn't gone away. It's just evolved. And the tariff war threatens to make it even worse. Sure, higher tariffs squeeze Chinese exporters, but they also push up prices for U.S. consumers. America still imports over $1 billion in Chinese goods every single day. Doubling those tariffs would send retail prices soaring, from electronics to clothing, making inflation nearly impossible to control. The U.S. economy is built on consumption. When prices surge, people spend less and confidence collapses. That's already starting to happen. Households are cutting back on major purchases, savings are shrinking, and credit card balances are exploding. On the production side, manufacturers are seeing their costs rise as imported components get more expensive. It's a vicious cycle. Higher costs lead to higher prices, which weaken demand, which slows growth even more. Behind the political showmanship, one fact remains. America can't keep raising prices on everything it imports without hurting itself. Every new round of tariffs chips away at consumer trust and fuels inflation expectations further. That's why Washington seems desperate to keep this fragile framework alive. Not because it's strong, but because the alternative would be chaos. The longer this trade war drags on, the more fragile the U.S. economy becomes. Beijing, meanwhile, is playing the long game. Yes, exports to the U.S. still matter, but they're no longer make or break. Global demand for Chinese goods keeps expanding. Over the past year, China's exports have climbed toward $4 trillion, and trade with the U.S. now represents barely 3% of its total GDP. Even if that entire channel disappeared, Beijing could absorb the hit. That's endurance. For Washington, it's pressure. Bessant insists China will soon resume soybean purchases, calling it a big win for American farmers. In his words, "I've felt the pain myself. China cutting our soybean imports to zero hurt our heartland the most. But with this new deal, our farmers will finally get relief." It's an optimistic promise. But for real farmers, the crisis is far from over. U.S. soybean exports to China have already plunged to zero. Storage silos are full. Farms across the Midwest are running on fumes. Even during the height of the 2018-2019 trade war, China still bought around 1.5 million tons of American soybeans per year. Today that number is zero. Washington has already prepared a $10 billion bailout to prevent widespread bankruptcies in agriculture. But bailouts can't last forever. The only real solution is for Beijing to lift its 10% tariff on American soybeans, roughly $12 billion in levies, and reopen the flow. But dropping those duties would come at a cost for China too, since it would mean cutting imports from Brazil and Argentina, who have now taken America's place as primary suppliers. So while Bessant celebrates a breakthrough, what we're really seeing is a fragile truce between two exhausted economies. The US can't afford another inflation shock. China can't afford another supply chain disruption. Both sides are playing for time, not victory. And that's the hidden story behind the handshake. So let's talk about the dollar, and why Washington is suddenly so desperate to protect it. There's a quiet panic in DC right now. A realization that the global order built on the dollar's dominance is slowly slipping away. That's why Trump is rushing to rally allies in Asia. The new tariffs are loud, yes, but behind them it's really about defending the dollar. When Bessent visited Japan, he didn't pressure the Bank of Japan to hike rates. He stayed unusually calm, focused on keeping the exchange rate stable, because the last thing Washington needs is a dollar crash. The dollar's already lost nearly 10% of its value this year, and global tariffs are only making things worse. Countries that once borrowed in dollars are starting to walk away. Why borrow in a currency that's losing value? In the first 5 months of 2025, sovereign dollar bond issuance by non-US countries fell 19% to just $86 billion. The first drop in 3 years. The lower the demand for dollar bonds, the weaker the global appetite for the dollar itself. Meanwhile, the world's economic map is shifting. The G7 is still clinging to dollar dominance, but the BRICS bloc is quietly moving in another direction, and China's reaping the benefits. Take Indonesia. They just issued their first offshore bond denominated in Chinese yuan, a dim sum bond, open to international investors. The message is clear. Countries are diversifying away from dollar dependence, because relying on USD funding means depending on trade with the US to earn dollars. And with tariffs rising, that trade flow is no longer guaranteed. Indonesia exports $24 billion in goods to the US, but America sells them only $10 billion. Trump's 19% tariff will shrink that surplus fast. Fewer exports, fewer dollars coming in, while imports of US energy, planes, and farm goods mean more dollars flowing out. And Indonesia isn't alone. Across Asia, countries are finding it harder to get dollars, even as US tariffs choke off trade. Borrowing in dollars now means double jeopardy, currency risk on top of trade risk. If dollar liquidity tightens, you could end up in an Argentina-style debt crisis. China, on the other hand, is cashing in. Global issuance of yuan-denominated dim sum bonds hit 720 billion yuan. Around $12 billion, up 8% year over year. This demand has been climbing since 2022, when the US hiked rates and the world began preparing for another dollar squeeze. Ironically, Trump's trade war is strengthening China's currency. Every tariff that pushes countries away from US markets pushes them closer to China's. China's exports to the world grew by 8.3% in September alone, even as US trade collapsed. Electric vehicle exports jumped 11%, semiconductors 30%, and shipbuilding 40%. Asian, African, and Latin American buyers are lining up for Chinese goods. And that means more global demand for the yuan. If you're buying from China anyway, why not borrow in their currency too? At home, even Chinese companies are dumping the dollar. In September, Chinese banks sold $52 billion worth of foreign exchange, as exporters and importers repatriated money back to yuan. Optimism toward the Chinese currency is surging. The stronger it gets, the weaker the dollar looks. Now here's the twist. Trump's trade war was supposed to weaken China by raising tariffs, but it's backfiring. The higher the tariff walls, the more desperate countries become for cheap Chinese goods, even with a stronger yuan. The US hoped tariffs would decouple economies. Instead, they've made China's role in supply chains even more vital, and the same logic extends to resources. Brazil now supplies over 70% of China's soybean imports, becoming its main agricultural partner. If Beijing ever returns to US soy, it won't be charity. It'll be a strategic move to gain leverage in other negotiations, like technology or finance. Sure, US soybeans are about $90 per ton cheaper, but even that discount can't offset China's 10% import tariff. Dropping it would mean lifting tariffs on $12 billion in US goods, a short-term boost that hides deeper compromises. The real battlefield, though, is in rare earths. The metals powering fighter jets, EVs, smartphones, and AI chips. 70% of America's supply still comes from China. For elements like scandium and yttrium, the dependency is absolute. 100%. That's why Bessent begged Beijing to delay export restrictions for a year. It's a temporary lifeline. Just enough time for Washington to panic buy. But here's the harsh truth. China doesn't just mine rare earths. It refines them. It holds 60% of global mining, but 91% of refining capacity. The world's second largest refiner, Malaysia, has just 4%. That gap is staggering, and it can't be closed overnight. Building new refineries takes 5 to 10 years. So even if China pauses exports, it still controls the choke point. The global supply chain still runs through Beijing. And the cost of this trade war? S&P Global crunched the numbers. A $1.2 trillion hole across global supply chains. Tariffs act like hidden taxes. Importers pay more for raw materials. Exporters lose profits. And consumers end up footing the bill. 2/3 of the damage lands on the public. Prices of essentials tell the story. Coffee up 19%, beef up 15%, bacon up 6%. Yet Washington insists inflation is coming down. The truth is, tariffs are quietly taxing the very people they were meant to protect. By freezing the 100% tariff plan, Washington isn't declaring victory, it's averting disaster. Subprime auto delinquencies are at 643%, even higher than during 2008. Credit card debt has hit record highs. Consumers are stretched thin, and one more price hike could break them. A full-blown tariff war could crash consumer spending, the backbone of the U.S. economy. That's why this so-called framework deal with China isn't about triumph. It's about survival. Both sides are pausing before they fall off the edge. But let's be clear, this isn't peace. It's a fragile truce. Beneath the surface, the structural rift remains. The chip war, the AI race, the scramble for resources. All are still accelerating. China is building a multipolar world through trade and infrastructure, while America retreats behind tariffs. Every deal now is just a timeout in a much longer game of economic survival. So was this really a trade victory, or America's quiet retreat from its own tariff war? Tell me what you think in the comments. And if you found this breakdown insightful, hit like and subscribe, because this story is far from over.